It is 22/6, and a magical machine has taken over the world. You can talk to it, ask it to write your homework, create a painting, compose a song, and it does all of it in about 3 seconds. CEOs are calling it the greatest invention since electricity. Investors are throwing their life savings at anything with AI in the name, and stock prices are going to the moon. Right now, as you watch this video, 4 companies, Google, Microsoft, Amazon, and Meta, are spending a combined $650 billion this year alone, just to build bigger and better versions of this magical machine. $650 billion in a single year. That is more than the entire GDP of Sweden. But here is the question nobody wants to ask out loud. What if this magical machine cannot make enough money to justify what we are spending on it? What if we have seen this exact movie before, and we already know how it ends? Today, we are going to explain the AI bubble like you are 5 years old. Let us start with what AI actually is, because most people who are investing billions into it cannot explain it simply. Imagine you have a very smart parrot. You feed this parrot every book, every article, every conversation ever written in human history, trillions of words. The parrot does not actually understand what the words mean, but it becomes incredibly good at predicting what word should come next in a sentence. That is basically what AI is, an insanely powerful pattern matching machine, not a thinking brain. Now here is where the gold rush begins. In November 2000, a company called OpenAI released ChatGPT, and it was like someone discovered gold in California all over again. Within 2 months, ChatGPT had 100 million users, the fastest growing app in human history. Every company on Earth suddenly wanted AI. Every investor wanted to own AI stocks. And if you were a startup and you put AI in your pitch deck, money fell from the sky. A Deutsche Bank survey found that 57% of global investors now consider an AI valuation crash the single biggest risk facing the stock market in 2006. But the money kept flowing anyway because of one powerful emotion: FOMO, the fear of missing out. Here is a real example. If a hot dog stand changed its name to AI Hot Dogs, investors would line up around the block. That sounds like a joke, but in 2025, a small company simply added AI to its corporate filing, and its stock jumped 35% in a single day before anyone even checked if the company actually used AI. This is textbook bubble behavior, and we have the receipts to prove it. Now, let me tell you about the shovel sellers, because this is where the real money is. During the California gold rush in the 1800s, most miners went broke digging in the dirt, but the people who sold them shovels, pickaxes, and blue jeans, they got filthy rich. A man named Levi Strauss built an empire selling pants to miners. In the AI gold rush, the shovels are computer chips, specifically the GPU, chips made by a company called Nvidia. Nvidia's revenue for fiscal year 2026 was $130.5 billion, nearly double the year before. Its quarterly profit hit $43 billion in a single quarter. Its market cap is now $4.2 trillion, making it the most valuable company on Earth. Jensen Huang, Nvidia's CEO, just announced at a conference on March 16, 2006, that he expects at least $1 trillion in revenue from AI chips through 2027. Nvidia controls roughly 85% of the AI chip market, which means every single company building AI has to buy their shovels from the same store. But here is the uncomfortable question. If Nvidia is the shovel seller, who are the miners, and are the miners actually finding any gold? The answer is complicated and a little scary. The biggest miners are Microsoft, Google, Amazon, and Meta, and they are spending staggering amounts of money. Google's parent company Alphabet plans to spend $185 billion on AI infrastructure in 2026. Meta is spending up to $135 billion. Amazon is spending roughly $105 billion. Microsoft is spending about $105 billion. That is $650 billion from just 4 companies in a single year. But here is the problem: the revenue coming back from AI products is nowhere near $650 billion. Microsoft is targeting $25 billion in AI-related revenue by end of its fiscal year 2006, which sounds impressive until you realize they are spending 4 times more than that on infrastructure alone. OpenAI, the company that started the entire gold rush with ChatGPT, is projected to lose $14 billion in 2026. Let me say that again. The company that kicked off the AI revolution is burning $14 billion more than it earns, and an HSBC analysis projects it will not generate positive free cash flow until after 2030. OpenAI has 40 million paying subscribers, and it is still hemorrhaging money, because every time you ask ChatGPT a question, it costs real electricity, real computing power, and real money to generate that answer. That brings us to a hidden cost nobody talks about: electricity. AI data centers in the United States now consume 41 gigawatts of power, which is roughly the same as every nuclear power plant in the entire country combined. Data center electricity demand is projected to more than double by 2030. Training a single large AI model can consume as much electricity as powering 1,000 American homes for an entire year. Somebody has to pay for all that power, and right now the bills are being covered by investor money and corporate treasuries, not by actual AI product revenue. This is the gap. The spending is real, the revenue is not yet matching it, and that gap has a very specific name in financial history. It is called a bubble. Now, before you say this time is different, let me take you on a quick time travel trip. It is 1990, and the internet is the hottest thing on earth. Every company is adding .com to its name, just like companies today are adding AI. Pets.com raised $82 million in an IPO to sell dog food online and went bankrupt 9 months later. Webvan raised $375 million to deliver groceries and burned through all of it in 18 months. The NASDAQ index, which is full of tech stocks, skyrocketed from about 1,000 in 1995 to 5,048 in March 2000. Then it crashed hard. By October 2002, the NASDAQ had lost nearly 80% of its value. $5 trillion in wealth evaporated. Over 50% of public.com companies simply ceased to exist. It took the NASDAQ 15 years to recover to its March 2000 peak, finally crossing above 5,048 again in March 2015. Here is what matters. The internet was real. The internet did change the world. But the stock prices were not based on what the internet was doing at the time. They were based on what people hoped the internet would do in the future. When reality could not keep up with fantasy, the bubble popped. Now look at today. The current NASDAQ PE ratio is around 33. In March 2000, right before the crash, it was 34. Nearly 80% of stock market gains in 22,000 were concentrated in just 7 companies, the so-called Magnificent Seven, and almost all of that performance was driven by AI hype. The similarities are not subtle, they are screaming. But here is where it gets even more interesting, because there is a wildcard that did not exist in the .com era. In January 2025, a small Chinese company called DeepSeek released an AI model that performed comparably to the best American models, but it cost only $6 million to train. For context, OpenAI spends billions training a single model. DeepSeek's release triggered a $593 billion single-day wipeout from Nvidia's market cap alone. It was the biggest single-day loss for any company in stock market history. Why did this matter so much? Because DeepSeek proved that you might not need $650 billion in shovels to find gold. If a small team in China can build a competitive AI model for $6 million, then maybe the entire premise behind the spending spree, that you need to burn hundreds of billions to win the AI race, is wrong. And if that premise is wrong, then the stock prices built on top of it are a house of cards. So, should you panic and sell everything? No, and here is why. A is real technology with real applications. Businesses are using it for customer service, medical diagnosis, legal research, software development, and thousands of other tasks. The technology itself is not fake, unlike the dog food delivery startups of 1990. But the current stock prices are not just betting on today's reality, they are betting on a perfect future where every dollar invested returns 10. If that perfect future is delayed by even 2 or 3 years, and the companies spending $650 billion cannot show matching revenue growth, the correction will be severe. The dot-com bubble did not kill the internet. Amazon survived, Google survived, and they became the most valuable companies in history. But the investors who bought at the peak in March 2000 waited 15 years to break even. So what should you actually do? First, do not put all your money into AI stocks just because everyone else is. FOMO is the most expensive emotion in investing. Second, if you want exposure to AI, invest through a diversified index fund like the S&P 500, which holds hundreds of companies, so even if the AI bubble pops, you are not wiped out. Third, remember the shovel seller lesson. In every gold rush, the safest bet is the boring infrastructure, not the speculative mining. Fourth, understand that the best time to invest in a real technological revolution is usually after the bubble pops, not before. The people who bought Amazon in 2001 at $6 per share made a fortune. The people who bought it at the peak in 1999 at $113 had to wait until 2009 to break even. AI will change the world. I genuinely believe that. But the question is not whether AI is real. The question is whether the price tag on it right now matches reality. A $4.2 trillion company, $650 billion in annual spending, $14 billion in losses at the company that started it all, and data centers consuming the electricity of every nuclear plant in America. The numbers are staggering, and the gap between spending and revenue is growing, not shrinking. Don't let FOMO write your financial future. If you want to keep understanding the hidden rules of money that Wall Street does not want you to know, hit subscribe, like this video, and I will see you in the next one.